using stock that you've already purchased to then exercise loophole that allows you to exploit the tax system and save a bunch of money, but now you're on the hook for a huge tax bill that you can't use company stock to pay for. There are 3 ways to exercise your stock options without using any cash. I'm going to show you how it works, how they're taxed, and what my personal opinion is on the approach. This may be the best $0 you've ever spent. The first way to exercise your stock options without using cash is actually going to be assisted by the brokerage account. So this could be Schwab, E-Trade, Fidelity, whoever is holding your assets. They can assist employees in doing a cashless exercise. Now, there are 2 different ways that they do this. The first one is going to be a same-day sale. The second is going to be a sell to cover. Now, both of these options are typically only applicable if your company is public. Now, as I address these 2 approaches, you have to first ask yourself the question, what is it that you really want by the end of this transaction? Do you want company stock or do you want all cash? The first approach, which is a same-day sale, is going to end up with all cash. The brokerage firm is going to then send all of the exercise price and withholdings. They're going to send that to your company. The second option that you have using your broker is going to be a sell to cover. And this is where they're going to use just enough shares to cover all the exercise costs for the remaining shares. So if you think about it, by the end of this one, you own mostly shares. If there's any proceeds that are remaining, they're going to send that to your account. And it's pretty frequent that these brokers pay themselves a fee. So not only is that sell to cover going to cover the exercise costs and any necessary withholdings, there could be a fee associated with that. Now this is going to be the exact same outcome as a stock swap, but it's going to be way less complex. I'll address stock swaps in just a minute. The brokers used to use a short-term margin loan on these transactions, but that's kind of a thing of the past, and they can do these things simultaneously now of selling and exercising at the same time rather than doing a short-term loan. It just gets really complex. And because they used to use short-term margin loans to cover the exercise cost, that used to trigger a interest-free loan, which was a taxable event. But because those short-term margin loans aren't used much anymore, that shouldn't be a problem. So as far as taxes goes with a same-day sale, it really depends on the type of equity. So if you think about it, when you exercise an NSO, you are subject to ordinary income taxes and you have withholdings. This next way of exercising without any cash is called a net exercise. So while that first approach was using your broker to assist you in doing a cashless exercise, the second approach is actually using your company to assist you in a cashless exercise. But similar to the last approach, this approach is going to be using company stock to pay for the exercise price and any withholdings. And again, it's imperative that you check with your company to see if they're willing to do this, because if your company isn't willing to sell their company stock, then this probably isn't going to be an option. And the equity documents that you need to check will also let you know on whether the company wants you to write a check for withholdings or if they will actually sell the shares to cover withholdings. And depending on the type of equity, it may trigger a variety of tax ramifications. So if it's incentive stock options, then just know that those incentive stock options are going to be disqualified, again, because that's just a short turnaround on the exercise and sale, and there won't be any withholdings on that because there aren't any withholdings on incentive stock options. Check with a tax professional to see if that's applicable. In the case of non-qualified stock options, it's going to be ordinary income due on the spread between the exercise price and the fair market value on the date of exercise, plus capital gains on any gains since the exercise, which for private companies is unlikely to happen because the stock price doesn't really fluctuate within the day like a public company stock would. These various exercise methods are completely dependent upon your employer and whether they allow them or not. And you can go to the one source of truth as far as what is allowable and what isn't, and that's going to be the plan documents. Some owners are going to view this as a lack of commitment. You don't have skin in the game. You don't have your own cash in the game. They're going to say that this is going to depress the company stock. They could be on the other side of the spectrum of them actually liking you using their stock to purchase company stock and doing a cashless exercise because it can help with dilution of the company equity. It can also get more stock back in the company's hand. Okay, let's go ahead and talk about employer loans, as this is a form of a cashless exercise where you don't have to have cash in order to exercise. If we think about equity compensation, it is at the intersection of the Federal Accounting Standards Board, the Securities and Exchange Commission, and the IRS. So all of these federal regulatory authorities, both accounting, tax, and investments, they all have a say on equity compensation. So it's really easy to mess things up. This means that a lot of things could go wrong. So if you're trying to adjust the plan document to get employer loans into the plan documents after the plan has already been established, then that could cause an adverse effect, especially for public companies. For example, it could take the beneficial incentive stock options and turn all of your incentive stock options into non-qualified stock options. If you're in employee, you still have to be careful here, because if your employer gives you a below market loan, that may be considered a taxable event because there isn't enough interest being charged. So that's just one of the problems that's at play here. Another example of something that could go wrong is if a promissory note is used, then the securities law and tax law could consider the holding period not starting until that note is completely paid off or sufficiently collateralized. And if you are at a public company, you just have to be careful, because the Sarbanes-Oxley Act of 2002 made it so that public companies couldn't offer loans to business insiders or anyone with privy information. The government doesn't really have any reason to incentivize you to do a cashless exercise. So if you think that there's some loophole that allows you to exploit the tax system and save a bunch of money, that doesn't really exist here. So similar to the previous approaches, we're using stock to exercise the remaining shares. And unlike the previous approaches, this one gets really complex really fast. I'm going to keep things really high level, so my apologies if you're looking for detailed explanations or lots of examples, but literally if I wanted to do that, it would be an hour-and-a-half long video on taxation of tax swaps, which nobody's going to watch that. Now we're going to talk about stock swaps, which is where you're using stock that you've already purchased to then exercise the remaining shares. So let's go ahead and start with an example here. We're going to say that you start with 23 shares. You've been granted 23 shares total, and of those 23, you've already exercised or purchased 3 of those shares. And you're going to use those shares, and this is going to be the same for ISO or NSO. You're going to use these 3 shares to then purchase the remaining 20 shares. So you started with 23, 3 were purchased or exercised, and you're going to use those shares to exercise the remaining shares. So you started with 23, you're now at 20 shares. But it's not simply just 20 shares that you're now the owner of. If you think about it, with these 3 shares that you swapped, they had a holding period or some sort of tax benefit, like the basis, that was useful. And that needs to be carried over into these new shares. But it doesn't seem to make sense if you only had 3 to carry over the holding period and the basis and all of those important things over to the remaining 20 shares. It only makes sense that you would just carry 3 of these shares into the 3 exchange shares. So oftentimes, and I'll walk you through the specifics in just a second, but oftentimes the basis and holding period are just carried over into these exchange shares. And again, that's a 1-to-1 ratio, and you'll notice that 3 plus 17 equals 20. So there's no crazy math going on here. It's simply we're taking these 20 shares and we need to then divide those into 2 separate groups, because we want to keep some of the tax benefits, if applicable, that we already had, because again, it is a tax-free exchange. And then the remaining shares are going to be called added shares or additional shares. And that's going to make up the remaining of the 20 that we didn't use to exercise the remaining 20 shares. Let me give you a quick rundown on exactly how these things are taxed. So we want to pay attention to 2 things that I've written down here. The first one is going to be basis, and the second is going to be holding period. And they're both tax constructs, but the first one is going to be basis. And the reason why that one is important is because the IRS uses basis as an anchoring point to determine if you have either a gain or a loss. They're going to ask, how much did you pay for it, which oftentimes is your basis, and they'll say, did the stock go up or down, and then accordingly give you either a gain or a loss that either needs to be taxed or written off. The second one is holding period, which is equally important because the holding period tells us if we're inching closer to either the long-term capital gains rate or if we're still in the short-term capital gains, because those are 2 separate tax rates, or in the case of incentive stock options, have we hit the qualifying disposition, and do we get the tax benefit that incentive stock options offer? So you can kind of see this matrix that I've drawn up here. And so we're talking about shares that we already own, either NSO or ISOs, and we're using those to exercise either NSOs or ISOs. Okay, so we're going to start with this box right here, which is using NSOs that we already own to exercise new NSO shares. And just as we've already explained, there are going to be 2 types of new shares that you have. They're going to be considered NSOs, but we have to differentiate those into 2 separate groups for tax reasons. So if we think about it, these NSOs had a basis and a holding period associated with them. So it makes sense if we're doing a tax-free exchange for these exchange shares right here, that we would just carry those shares over. We've already paid taxes on them when we first exercised these NSO shares that we already own, and we've already held these for a long time. So it just makes sense that there's a 1-to-1 ratio on that conversion there. When it comes to the added shares, we are purchasing these NSOs for their very first time. time. So it makes sense that we wouldn't carry over a basis or even a holding period. So with the added shares, the holding period starts from the day that these shares are swapped. So you're going to have a basis of 0, which means that you are going to be on the hook for taxes. Whatever the fair market value is on the day of the swap is what your new basis is. And as soon as you pay taxes on that raises your basis. So hopefully that answers both the holding period and the taxes on that date and the basis. So as far as incentive stock options are concerned, it really takes it up a notch as far as complexity. And this is why I'm not going to go through an example, because I would have to go through an example here, and it's just going to get more complex. And so I'm actually going to keep things really high level. Okay, so now we're going to transition into using NSOs to exercise ISOs. And you'll notice that I've got a matrix within a matrix here. And the reason for that is because when it comes to incentive stock options are given a tax benefit from the government. This tax benefit is known as qualifying disposition. And if you don't meet that tax benefit or that requirement, then it's disqualifying disposition, which I've titled this left column as disqualifying, this right column as qualifying disposition. And in order to get the qualifying disposition, you need to have held the shares for 2 years from the date of grant and 1 year from the date of exercise. And that's why we're trying to keep in mind the holding period and see if it carries over or if it's a brand new holding period starting on the date of swap, because we want to see if that's qualifying disposition or disqualifying disposition. And the tax benefit is just more of your gains being subject to the more advantageous long-term capital gains for those that get qualifying disposition. That's why we want to pay attention to the holding period here. Let's go ahead and start with the exchange shares subject to disqualifying disposition. Now with exchange shares, and we'll kind of notice a pattern here, they're coming from somewhere. We're taking these NSOs and we're going to exchange them for ISOs. So because these exchange shares, I guess you can kind of like treat it like a family tree. They're bringing part of the NSO family with them, or whatever like the holding period or basis is. They're like, hey, I'm part of this family, so I'm going to bring a little bit of that with me. So you'll kind of see that pattern throughout the rest of these examples here. And so in this example, when there is a disqualifying disposition, the holding period is going to be carried over directly from this NSO. So if you've already held it for 2 years, then you will have long-term capital gains treatment of the exchanged shares. But when it comes to the basis of these exchanged shares in disqualifying disposition, they aren't going to be bringing in exactly everything from the NSOs. And this is where, again, it differs on all these various complexities. But when it comes to ISOs, when they are exercised, you don't typically pay ordinary income tax on those shares. Whereas when it comes to NSOs, you do pay ordinary income tax on those shares. So we're bringing two things that are very different and we're meshing them together. So the basis when it comes to these exchange shares are actually going to be the fair market value on the date of the swap. And if you don't dispose of the shares before the end of the tax year, they are going to be subject to AMT. So they're bringing some attributes from their ISO family and some attributes from their NSO family, and they're mixing them together right here. But for the most part, as far as incentive stock options are concerned, the taxation is going to be deferred until you actually sell the stock. And when it comes to the added shares, those are actually going to be taking the holding period starting from the swap date. So it doesn't actually bring that portion from the NSO side. It just says, hey, we just barely exercised these shares, so the holding period is just going to start on that swap date. When it comes to the basis is actually going to be $0 unless you use cash to pay for those shares. And you're not going to raise that basis until you actually pay taxes on it. And then once you pay taxes on it, then your basis will be raised. Okay, and then the last portion of this matrix, which is using NSOs to exercise ISOs that are disposed within qualifying disposition, which is 2 years again from the date of grant and 1 year from the date of exercise. So as far as exchanged shares are concerned, again, we're going to be bringing in two families. The exchange shares are going to be bringing a little bit from their NSO side, and they're also going to be bringing a little bit from the ISO side. So as far as basis is concerned, that's actually one aspect that's going to be carried over from the NSO. So whatever taxes you paid over here, it's going to be carried over to the exchanged shares, and taxes are going to be deferred again until the shares are actually disposed of. The basis is just going to be carried over from the NSO. So remember, you've already paid taxes on these shares when you exercise them. So that basis is coming over here. You've already paid taxes on it. But when it comes to the holding period, you're not going to take over the holding period from here, which is a little unfortunate, but it kind of makes sense. You are going to be starting your holding period from the swap date. So it starts brand spanking new from when this swap happens, just for these exchanged shares right there. Likewise, when it comes to the added shares, they are going to be taking the holding period from the date of swap. So there is no real benefit there. Like you can't can't take the good from the NSO like holding period. You can't take that positive attribute from that ancestor. You're gonna have to start fresh with the ISO family. And then as far as the basis is concerned, and again, that's important for tax reasons, the basis is gonna be 0 until you pay taxes on it, and taxes are deferred until you sell. So the swap doesn't trigger the taxes, the sale will actually trigger the taxes. So I know this has gotten complex already, but it actually gets more complex. For the sake of this video, I'm actually going to keep things simple and high level. I'm not gonna go into all the intricacies that are involved here, but just a quick recap. We have two different types of ISO shares. We have disqualified and qualified shares. So if we think about it, when it comes to using ISO shares, we will also have disqualified and qualified shares that we could use to swap and buy some more ISO shares. So the term that we use here is actually going to be mature versus immature shares. Mature shares are going to be the shares that have been held for the 2 years since the date of grant and 1 year from the date of exercise, whereas immature shares have yet to reach that qualifying disposition. In the spirit of keeping things high level, I'm just going to quickly mention that immature shares, using shares that have yet to meet that qualifying disposition to exercise ISO shares, just gets even more complex than it would otherwise. So I'm just going to put a big red X here. There's something called the anti-pyramid rule, which really makes things very difficult. And in fact, it can oftentimes lead to huge tax outcomes. The tax outcome is much larger than it would have been otherwise if you had just used cash to purchase these shares. A lot of times it's not very worth it, and it would only be worth it if you know that you're actually going to have qualifying disposition. Again, it just gets really complex here, so you don't want to be using ISOs to exercise ISOs and then be selling within a year of exercise. So you really got to make sure that you know what you're doing, and this is why I recommend highly working with a professional. Lastly, I'm going to cover exchange and added shares for those with qualifying disposition and ISO swap. So if that's not inception on the matrix within matrix here, like I don't know what is. This is just laughable at how complex it's already getting. But as far as the exchange shares and the added shares, in fact, there are no taxes due on the day of swap for either the exchange or the added shares. There could be AMT if it's not disposed of within that same tax year that they're swapped for. The exchange shares are going to carry over the basis, whereas the added shares are going to have a basis of 0, again, unless you're paying cash for them. And then as soon as you pay tax on them, that's what's going to raise the basis. Now, these will both share the same holding period for both the exchange shares and the added shares, and they'll both have the holding period start on the day of swap. One last option that's available to you is using third-party loan providers. What these companies offer is a non-recourse loan with the underlying stock being the collateral. You just have to be careful because they oftentimes tout that it's a non-recourse loan, making it sound like there's no problems with it whatsoever. Even if the stock goes south, you're not on the hook for anything, right? Well, at least not from them. Non-recourse loans sound great from the standpoint of you don't have to pay the company back even if your stock tanks and it becomes completely worthless. So it is nice from that perspective, but there are still some problems that could happen. For example, if your company stock becomes worthless and the non-recourse financing says, okay, we forgive the loan, that's great from that standpoint, but guess what? The IRS considers loan forgiveness a taxable event. Let's say that you had $500,000 worth in company stock that then became worthless. So the third party forgives your loan, which is all great, but then the IRS says, hey, that was $500,000 worth of a loan that was completely forgiven. The IRS will tax you $500,000 worth of ordinary income in a single tax year. That feels like salt in the wound. Not only did you have your company's stock become completely worthless, but now you're on the hook for a huge tax bill that you can't use company stock to pay for.